Fitch Rating expects Turkey's debt capital market to pass $540 billion in 2026, driven by high external financing needs, substantial upcoming maturities, and funding diversification goals. Expected rate cuts by both the Central Bank of the Republic of Turkey and the US Federal Reserve could provide a more favorable funding environment. The sovereign is likely to remain the main driver of DCM issuances, and emergence of Turkish denominated notes and asset-backed sukuk is increasing diversity. The sovereign and many private sector issuers continue to exhibit DCM access through periods of stress. The DCM is exposed to interest rate and foreign exchange volatility, geopolitical risks, high inflation, and tariff risks. Turkey was the fourth largest emerging market US dollar debt issuer in 2025, excluding China. Turkey's DCM outstanding expanded by 13.5% to over $503 billion at end of 2025. DCM issuances increased by about 14% to over $140 billion. Turkey was the fifth largest sukuk issuer globally in 2025. Sukuk issuance surged by over 54% in 2025, surpassing $18 billion and accounting for about 13% of the debt capital market. Fitch recently revised Turkey's outlook to positive from stable. All Fitch-rated sukuk issuers are also on a positive outlook, and around 98% of the sukuk rated BB- and the remainder B+. Non-resident holding of domestic sovereign debt fell to 7.6% by end of 2025. The majority of the investors are resident banks at 59.4%, while the investor base is becoming more diversified, with the non-banking sector share up to 30.7%. It was 20.2% in 2024. Turkey hosting COP31 could catalyze further ESG debt issuance. ESG US dollar debt was over 10% of Turkey's dollar DCM outstanding in 2025.